Hello and welcome to the NDA podcast series on business transfers. I, Harshita Srivastava, I'm the co-head of the M&A practice of the firm, and I'm joined by my senior colleagues Khyati, Dalal from our corporate team and Ipsita, Agarwalla from our international tax team. Through this podcast series, we will be discussing and examining the basic structure of a business transfer, how it differs from other modes of an asset sale or a share sale, and the merits and demerits over other modes of acquisition. In doing so, we will explain the legal, tax, and regulatory implications of a business transfer, and we will also cover certain key commercial considerations that are often heavily negotiated in deals. For the benefit of the audience, we have divided this series into 5 broad parts. In the first part, and to begin with, in the context of M&A transactions, how you acquire is as important as what you acquire. The structure of the transaction that you choose could either make or break your deal, especially in a jurisdiction like India, where the consequences of a wrong choice of structure could outweigh the benefits of the transaction itself. Therefore, naturally, one of the most fundamental considerations in any M&A transaction is the mode of acquisition. The choice of the mode of acquisition can have far-reaching implications for both the buyer and the seller. Inter alia, in terms of legal compliances, taxation, successor liability, employee transfer, stamp duty, besides the other obvious commercial considerations involved. Traditionally, the choice for the acquirer has always been between acquisition of the company conducting the business and the acquisition of the business itself. Each of these come with its own set of pros and cons. In the Indian context, acquisition of business can be through transfer of an entire undertaking as a going concern. And this transfer could be achieved in 2 different ways. One, a slump sale, and the other, a court-approved demerger. Since each of these modes of acquisition will have significant and different implications for the buyer and the seller, it is important to choose a structure that meets the expectations of the parties, complies with the legal requirements, and most importantly is tax efficient. The terms business transfer and slump sale are used interchangeably in the Indian context, and both refer to transfer and sale of an entire business undertaking from the seller to the buyer on a going concern basis for a lump sum consideration. Slump sale is purely a tax concept. And with this, I will ask my colleague Ipsita to chip in and explain to the audience as to what does the IT Act, the Income Tax Act, say about a slump sale.
Sure, thank you, Harshita. So, for a transaction to qualify as a slump sale under Indian tax laws, there are certain prerequisites. To begin with, one of the most important consideration for qualification as a slump sale is the subject matter of the transfer itself. What has to be transferred in a slump sale is an undertaking. Undertaking as a concept is defined under the Indian tax law, and several courts have also alluded on what is the meaning of an undertaking. In simple terms, the transferred undertaking should represent an identifiable standalone business activity and should contain all assets and liabilities, including employees, contracts, and licenses that are required for conducting such business. The transferred undertaking should have the inherent ability and potential to run the business which is being transferred, and also should be able to generate revenues independently. Having said this, one of the most important issues which generally parties struggle with while structuring a slump sale is whether all assets and liabilities are required to be transferred as part of this undertaking. On this issue, ideally, all assets and liabilities forming part of the transferred business should be transferred to the buyer. However, case laws indicate that exclusion of certain assets and liabilities is permitted so long as the assets and liabilities transferred are part of the undertaking which is sufficient for conducting and generating revenues on a standalone basis. This is the first prerequisite from a tax perspective. Moving on, the second most important aspect from a tax perspective is that the transfer should happen on a going concern basis. When I say going concern, There should be no break or cessation in the operations of the transferred undertaking. The transfer of the undertaking from the seller and vesting of the undertaking in the buyer, together with all the assets and liabilities, should take place on a simultaneous basis, and it should not stop, hinder, or break the conduct of business in any way. Thirdly, the prerequisite from a tax perspective is that the transfer should happen on a for a lump sum consideration. The meaning of lump sum consideration is that since it is a transfer of undertaking and not specific identified assets, the consideration that is being discharged should be on a lump sum basis and without attributing individual values to the assets and liabilities forming part of the transferred undertaking. However, because from a stamp duty perspective, it may be relevant to identify or attribute value to certain assets that are being transferred under a slump sale also, the Income Tax Act allows for attribution of value to certain specific assets from a stamp duty perspective. Lastly, when we talk about transfer, the mode of transfer is also important when we are talking about a slump sale. So, under the income tax law, the transfer of an undertaking to qualify as a slump sale can either be for a cash consideration, which typically is known as a sale, or it can be for a non-cash consideration, which may be in form of, say, a swap of shares or exchange of any consideration in kind. So any kind of transfer, it does not have to be necessarily for a cash consideration, would come under the definition of would qualify as a slump sale from a tax perspective. So these are the essentially four main features that have to be ensured are fulfilled to qualify as a slump sale from an income tax perspective.
With this, we come to an end of part 1 of the podcast series on business transfers.